Markets have crashed historically a lot of times. There was the dot-com bubble in the early 2000s. Then there was the real estate bubble in 2008, the big financial market crisis. And whenever any market becomes too big, in the sense that if you look at how S&P 500 has been behaving in the past few months, past few years rather, is that despite the fact that there is so much geopolitical crisis going on, I mean, US is fighting wars in Iran, there is a war going on between Russia and Ukraine. There's so many things going wrong, right? But still, S&P 500 keeps going up. And that is on the basis of the optimism around AI, that AI will grow. Now, if AI does not really bring the results that the world is expecting it to, that is the bubble. So if you look at it in comparison, the understanding was .com will never crash because internet will be the next big thing. But these things have crashed. Housing market turned out to be a big bubble. Companies started shutting down. People started losing jobs. People stopped paying their mortgages. Then where do banks get their money from? Who is going to give you money? If people start pulling out their money from Wall Street, then people will start pulling out money from other places in the world. Suddenly you will see that, oh, India has no foreign exchange. Emerging economies, people will stop buying things, so consumer spend will fall. And if consumer spend falls, then all the companies will suddenly stop making money. So yeah, it's a big cycle of how things can go wrong very quickly for everybody if something like this happens. And the reason why it is very important is because in the past few weeks, some AI companies have had a major heart attack moment, especially with Nvidia losing their share value. And the problem with AI market is that some of these companies have become so big, especially Nvidia, Micron, that they are just another situation where they are too big to fail. And because your entire S&P 500, your entire Wall Street basically is riding on these major tech companies, it will have a cascading effect, right? Everyone talks about how AI is going to be the future. If, say, an Nvidia fails, even by a very small margin, then the entire market will collapse, which will be a very bad thing. The person we have today is American behavioral economist, founder of MarketPsych, and someone the Associated Press once called Wall Street's top psychiatrist. He built his career studying how sentiment in news and social media actually moves markets. And right now, there is no busier patient on his couch than the AI trade. Richard, welcome to Zero Sum. How are you doing today?
Thanks, Harsh. I'm doing very well. Appreciate it.
Let's just quickly get into what is happening with the markets, right? When we talk of AI bubble sentiment, you're not just going off a gut feeling, right? You're actually tracking the mentions of these things across the markets. So what does data tell you now? Where does this sit compared to whatever has happened earlier in the markets when it came to a bubble or not?
Yeah, it's a great question. And, I think it helps to go back and look at what is sentiment. How do we understand how people feel in the markets? And then what does the data show about how it actually predicts prices or doesn't in different cases? So what we do is we monitor about 1,000 premium news channels globally, business news sites. And then we monitor another several dozen social media forums and sites where people discuss investments. And we do this globally. We do it in 28 languages, especially for news. And we find that when we categorize the tone that people use to describe individual stocks or sectors like AI or aerospace, we can then create a time series. And so, we have this data since 1998. And so we can look for the last 28 years or so. We can see how people felt during the dot-com bubble, both on the way up and then on the way down. And we can look and see, was there any way to notice that the feelings predicted the prices, or did the prices really just predict the feelings? So if the market drops one day, people feel negative, that's true. But the day before, were people already feeling negative the day before the big drop? So sentiment is really classifying how did people express emotion, how did they feel about these companies the days before a big market move? And that's sentiment, the feeling. And then as scientists, we want to know, studying these feelings day by day or week by week, does a shift in those feelings or the level of those feelings predict where prices are going? So with the AI bubble, what we've seen was a huge increase in positivity starting when ChatGPT launched, right? And first we saw that around, Nvidia and other Broadcom, of course, and then it's migrated over the years. There's been cycles. It's this year with the memory makers, SK Hynix and Micron, for example, Samsung. So we see that what generally happens is there's a huge spike in positive feeling. Those prices start to move, and by the time they've doubled or so, sentiment starts to come down. People, especially in social media, start to become a little more skeptical and say, hold on, this thing has doubled. I think it's time to be careful, get out of it, etc. So the news media, however, generally beats the drum like this is amazing, this is going to change the world, more so surprisingly maybe than social media. And so over the years, we've learned a few things from this, but that's the big picture. So we're measuring how people feel. We've seen cycles. We've seen it since the dot-com boom. And I can give you a bit more information about what we're seeing now, but maybe you have some questions about what I just said.
Yeah, I mean, we would love to know what you are seeing right now. And just to sort of add to that before you mention what you're seeing, is everyone keeps comparing the current AI bubble. In fact, just before this, you got on the call, I was talking to our producer, and we were discussing how the dot-com bubble might be similar to what we are seeing right now. Is this an actual comparison that should be made, or are we just sort of, pushing a narrative which might not exist because the world has changed a lot, right? Now the way sentiment changes, how we sort of deal with markets is very different from what it might have been 20, 30 years ago, because there's so many influencers, so many social media, so much social media, sometimes sensible stuff, but most of the times nonsensical stuff going on. So is this a fair comparison to have?
I think it is at the extreme, but in the beginning, like you said, this time is different in some ways. There's real money. I mean, Nvidia has enormous profits. Micron is making tremendous margins on their memory. So there's real money versus in the dot-com boom, there wasn't real revenue coming in. It took a decade before the real revenue started coming into firms like Amazon, for example. So that's one issue is there's real revenue right now, but with the bubble cycle, the way it tends to work is the real revenue comes in and then a lot of competitors come out. So you see Nvidia has actually not maybe performed as well as you would expect given the massive revenues that's coming in. And part of that is, money's going into AMD and money's going to Cerebras, and they bought Grok, another inference chip company. So there's cheaper ways of there's competitors coming out. AMD is building their own chip. Google has theirs. Now SpaceX is building a chip. So competition, when there's real revenue in the market, competition emerges. And then the question is, do the margins collapse? And the bottleneck to all of that, not all of it, but most of it is TSMC. So then you can say, well, the TSMC will do great because they're the bottleneck there and everyone needs TSMC. But what about the Chinese competition that's coming and the cheaper chips from Huawei and the fact that you can link up four, I forget how many, 4 or 6 of those and, have the equivalent. And, sure, it uses a bit more power, but power is half the price in China. So now you're looking at, well, actually, maybe China could be a big data center headquarters, especially as the power is cheaper and the chips are cheaper to make.
There's just so many variables in this.
Variables. Exactly. Yeah. So that just brings you to the big picture. There's the pattern here, which is a lot of profits. Everyone jumps into the competition, but in the first stage, no one knows how much profits will accrue before the reversal will happen, before the margins get compressed. So it goes up, and then you could have said in 2024, there were a lot of people making an argument, oh, we're at the top of the bubble. And then 2025, oh, we're at the top of the bubble now. Now we're in 2026. So, and if you had sold out, you would have missed, another 500% in some of these companies. So, how do you know when the top is? And usually it's this dissociation between the competitors are entering the market, the profits aren't quite coming, and then we see the sentiment starts to drop. So once the sentiment, is high at the beginning, and then it kind of moderates as the bubble goes on. But then you'll see the sentiment really plummet, usually because the profits aren't there, or there's some earning disappointment. Expectations aren't met, and so right now the expectations are very, very high, and we have a lot of signs of a bubble. Like we have these leveraged ETFs, single stock ETFs, which is a bit insane.
We at Invez have spent the past decade and a half providing our 1.5 million monthly readers with the latest news and why it matters to you. If you are enjoying this episode so far, please do us one quick favor and hit the like button. This tells our guests that you, as a listener, are worth their time. And if you have an idea on what we should cover next, please let us know below. Thank you. Now back to the show. That's
You
just
know,
a bit mad, right? A
yeah,
single stock ETF, just these things don't really make any mathematical sense.
exactly. And so that tells you, yes, we're in a speculative bubble right now. It doesn't mean there won't still be, equities that like there will be a lot of survivors from this who have a big profits coming out, but there are some that are, like you said, it's mad. How can we justify this now? The Even with those single stock ETFs, that means there will be more volatility. It doesn't mean it's over. But the thing that usually ends a bubble is more and more companies go and IPO and suck the liquidity out of the market. So once you have OpenAI, Anthropic IPOing, which might happen this year, and you have hundreds of billions pulled out of the markets of liquidity, that means there's less speculative capital out there and available. SpaceX already did this, so we lost 60 billion in speculative capital. We're going to lose more, and once that happens, things are in fact for the rest of the year, things are probably not going to be as vertical as they've been. They'll probably be much more moderate or even down.
Yeah, I mean, this we are living in a market where maybe 20 years ago there was not a single $1 trillion company, and now we have what say about $14 trillion dollar companies. So there is actual money in this market. We saw it with SpaceX IPO, the amount of money people sort of rushed in, and then the stock crashed, and then people lost money. And yeah, these things have a cascading effect, right? But one thing that really sort of drives me mad at times is how a single person can really move markets at a time like this, which is where market sentiment really comes into play. For example, somebody like Elon Musk would go to his personal social media platform X and just write something like Doge, and the cost of
Right.
the price of that cryptocurrency will skyrocket, and everybody would suddenly start posting pictures of dogs and God knows what not.
Yeah.
But then there are also people like Michael Burry. They will talk something about Nvidia or Palantir, and the stock will either crash or go up. So, how does an influencer, or how does a person who is so powerful in these markets, what goes on with the psychology of that, and why do fundamentally really strong companies take such big hits from one investor's or one random celebrity's position?
So I think it helps to think of humans a bit like herd animals, right? Like
Yeah, that's the
we're in
only
a
explanation.
we're in a complex environment where there's a lot of
Yeah.
information we don't, and none of us are experts in AI. I mean, a few thousand people in the world are really understand what's happening. And are they experts in manufacturing chips? No, they're maybe experts in something else. So how many experts are there really? And so we have to lean on each other for information. It's the economy, the way it works. With people specialize. And so we've got to, so with the environment of uncertainty and knowing that what we know that we're weak in certain areas, we have to rely on experts. So now relying on experts, as we all know, can often lead to tragedy. But we don't know what else to do. So, now we can ironically use AI to, very quickly educate ourselves about certain sectors, but it is trained on the past and
We can
past.
we can use AI to ask itself what about AI? Ask AI
Exactly.
about AI. Yeah.
Right, which creates this whole other interesting, feedback loop in the cycle. Um, but fundamentally, I think the role of influencers, we see it everywhere, that we need something to rely on, some expertise, and usually influencers are very confident. You'll see that they have a certain tone of confidence. They probably have some expertise in an area that we don't, so we're more likely to believe them. They're not they don't moderate their language with skepticism or doubt. So it creates this influential effect. And Michael Burry is a great example. I mean, I'm absolutely sure that Nvidia is in a bubble and is going to fall, for example. And we know that he has a past track record, so it's easy to do that. But people forget about his other track record, which is he had to close his fund because he's been making negative calls for so long that he doesn't have investors left. Again, which also happened in the dot-com bubble. So,
The joke is that Michael Berry has got one thing right in his life, right? And he got
yeah.
a movie made out of it. And then, yeah, everybody knows him.
And it's like the stopped clock, it tells the time accurately once per day. So,
Yeah, exactly.
hey,
Twice,
there's
actually. A stop clock tells the time,
twice.
correct? Twice or once?
Twice per day.
Sorry. Yeah,
That's right.
sorry.
That's right. But yeah, so That's influencers. And we see with the sentiment right now, we see that there, when you actually aggregate all the social media sentiment and news media sentiment, you see that the firms that make the hardware still have very positive sentiment, like Nvidia or AMD, Cerebras. But it's the ones now that make the servers. So what's happening? The story in the last month is that token costs have been very high, but they're decreasing. And I don't know about you, but I've used Fable quite a bit in the last week, and I keep having to add every time I run a legal document through it, I have to add like $8 of tokens to get an output. And I'm like, this is insane. Like, I mean, it's certainly a lot cheaper than a professional lawyer to read it, but it's like, wow, this is a lot of money coming through these tokens. And but token costs in general, now the open source models have done very well, like ZAI's models. So you're getting lower and lower token costs, and who's going to really benefit there is the hardware makers. Again, Nvidia, Huawei in China, AMD, Cerebras. But on the other side, you've got people who are making. Oh, and actually, and others that are going to benefit would be the optics makers, so fiber optics, networking gear, and a few of those. We actually had a list that we noticed recently: Arista, Credo, Coherent. Those are some networking groups, and then foundries like Lam Research, Applied Materials. They're at the very core of AI, and so no matter what happens, we know AI is here to stay, and it's going to keep moving. Um, but token costs, the decline in token costs will really hit OpenAI, Anthropic, for example. So there's different groups that are going to benefit and be hit right now. And so I think the story of the last 3 years has been small bubbles in different areas, some popping and some growing, and that may continue.
Yeah, it's a lot like the title of our show, Zero Sum. Somebody is winning,
Yeah, that's
but
right.
somebody is losing. Yeah, I mean, it's just
Exactly.
it's how the game works. In fact, we are quite short on time today, so we
Yes.
obviously I'll just take this opportunity to also say, please come back to our show. We love you, and it would be great if to have more time with you. But yeah, just following up on that, there's a human cost to all of this, right? There is, we talk about AI, we talk about investments, we talk about the money being put in and the money being made and the money being lost. But in all of this, there's a big human cost also, which is people are losing jobs. And companies are sort of justifying it by saying things like, oh, we are, spending money on AI, and how AI could deliver what humans were delivering or could not deliver that way. What is your take on that? I mean, how do we explain that to a future generation? Why did so many people suddenly lose their jobs?
So I'll just preface this by saying there's a conflict of interest in that I run an AI company, so I'm kind of biased here. So right.
Fair enough.
But I will then cherry pick some data points. In the last year, software developer jobs have actually the openings have increased 15% in the United States. So while there was in 2024 a pause there, and it declines, now there's been an increase. And one could argue that in 2024, really the decline was because there was such an overhang from the 2021 overhiring. So I think we're actually seeing, well, we are technically seeing more software developers being hired, software engineers. So that's narrative isn't quite the case. And then in terms of displacement, Revelio Labs found that companies that use more AI actually hire more headcount. So the more that your company is using AI, the more you're hiring. And so I think there's always a tendency we all listen to doom and risk because again, we're human and we want to avoid getting hurt. And because like you said, it can be a zero sum game. If we're dead, we can't play the game at all. So we want to stay in the game. And so we're always looking out for risk. And so people like Michael Burry get a lot of attention. But that doesn't mean we shouldn't, we can't take risk with some, thoughtfulness about it. And the media, because it knows what we pay attention to, will focus on those negative stories. And CEOs can use that as good air cover for when they lay people off. They can say, oh, there's a transformation, but actually maybe it's mismanagement at their company. Maybe they overhired in 2021. They don't want to say so. They don't want their employees to feel bad when they lay them off, or at least not to be bad about the company, but to be mad at AI instead. So there's a lot of potential motivations for those. But I don't believe it. I think AI will create more jobs, and I think that's what we're seeing.
Well, let's hope so. I mean, because who doesn't like to have their jobs? Final question, which is a very straightforward one. Do you think we are in an AI bubble? If yes, will that bubble burst and when?
So I think we're in industry level bubbles. I think memory now has a lot of signs of a bubble, like Micron, SK Hynix. When you see these single stock futures, when you see, most of South Korea is invested in something, that's it's not that it's not a very profitable company. It just means it's oversaturated and that there can be a decline. It's a bit like we saw with Bitcoin and crypto a few years ago. And as we see now with Michael Saylor and MicroStrategy and these Bitcoin treasury companies, it on the downside now we're seeing regardless of how valuable Bitcoin is, which is obviously debatable, but you're seeing on the downside this acceleration of the downside because so many companies levered themselves into Bitcoin. Now they're levering themselves out of Bitcoin, and they're going to do some damage on the way down. So with perpetual futures and single stock ETFs, especially levered ones, when the decline begins, you're going to see some damage on the downside too, regardless of how profitable those companies are. Now, because they remain profitable and they have good earnings, they can come back up. But I guess the long story short is we're going to see a lot of volatility. You could have said Bitcoin was a bubble in 2013 too, and it kept going. So you can say the same thing with these companies. I think AI is here to stay. There will be competition. I think you have to look intelligently at where is there competition and where is there not. A lot of people say there won't be competition on the memory side, but then others like Cerebras have built memory into their own chips. So there's different types of competition from different angles.
I completely agree. I think my view on the bubble is that there is a bubble, but there are also multiple bubbles inside it. So some bubbles will burst, some will not, some will just keep growing, and yeah, it's just a loop that we'll have to figure out as we go in life. And maybe future will tell us what's happening. Maybe AI will come to us in a robotic manner and tell us, oh, this is what I told you 5 years ago. So yeah, something like that will happen. Very Matrix vibes. Anyway, final thing, as you know, we have the section on our show, which is what are you bullish on, what are you bearish on, and what could be your wild card.
Yeah, absolutely. But so what we're seeing is generally networking is still quite bullish, networking and optics. So companies like Credo and Coherent and Arista, they still have, I think, some room to go. But on the downside, we're seeing some of the server makers like HP and Dell are sort of at extreme high sentiment right now, and they've been getting a lot of recognition. And as we go forward, if token costs drop, there will be less demand for those servers. So we'll see. They may be a bit vulnerable. And of course, the memory makers are, I think, overextended right now as well in the short term. But longer term, there still is a shortage of memory.
Your wild card?
So for the wild card, I'd say nuclear energy, solar, batteries. I think data centers are still going to be being built out as they are, and energy the costs still have to drop. And I think solar, of course, is the cheapest. With battery storage, then it's going to be much more effective and useful. So I think solar, batteries, and nuclear are going to be the wild card.
Thank you so much. This was an absolutely brilliant conversation. Well, quite, we had to just rush through it very quickly. But thank you so much for taking out time and talking to us. And yeah, we would love to have you back on our show whenever you find time.
Oh, thanks, Harsh.
Thank you.
Yeah, great to chat. Okay, take care.
Yeah, he was such a well-spoken guy. I mean, he was so level in his voice. Lovely. Great. And I felt like he had a really nice mic also. I don't know what it was. But yeah.